For every dollar of foreign investment coming into Canada over the past decade, $2 left. And increasingly, the people are following the money. Welcome to the Daily Brief Canadian Macro. I'm Steve. Today's episode follows one thread from 3 different angles. Alex McFayden dug into the macro data on Canada's trillion-dollar capital exodus and what it's doing to the housing market. Blueprint Financial mapped out how individual Canadians are actually engineering their exit. And in our third segment today, we're doing our own analysis. Because once you see those first 2 stories, you have to ask, what's happening to the Canadians who haven't left and can't? Let's get into it. Alex McFayden's central argument is that Canada has experienced a structural, not cyclical, capital problem over the last decade. The source is a recent RBC Thought Leadership report which found that between 2015 and 2024, more than $1 trillion of investment left Canada, the largest capital exodus in the country's history. $2 out for every dollar in. McFayden connects this to something most housing commentators miss. The Bank of Canada's own research showing roughly 40% of Canadians who would rank in the top 1% of earners have emigrated to the United States, along with 30 to 50% of the next 9 income percentiles. His point is that losing those earners doesn't just hurt the tax base, it hollows out the move-up buyer chain. Banks prefer lending $1.5 million to one high-net-worth borrower over 5 people at $300,000 each. When the family trying to sell a $1.8 million home to buy a $2.5 million home has no buyer, the entire chain seizes. Rate cuts don't fix that. You can't cut your way to a buyer who no longer lives in the country. What connects to the next segment is McFayden's observation that the foreign direct investment that did come back in 2025, nearly $97 billion, an 18-year high, is industrial and institutional capital, pension funds and M&A transactions, not the household capital that buys top-tier homes or builds a local economy with small businesses from the bottom up. Blueprint Financial's contribution is the micro-level mechanics of what McFayden described at the macro level. Their thesis is that leaving Canada is more executable than most people assume, and for a growing number of Canadians, it has become the rational financial plan. They map 4 distinct exit pathways. Young Canadians with location-independent income and lean asset structures, meaning they have no non-registered portfolios with unrealized gains, can leave with relatively low friction. Wealthy retirees are looking at structures like Greece's 7% flat tax regime, which Blueprint calculates works out to effectively 15% after Canadian withholdings versus 30% or more under Canadian rates. Finance professionals are using TN visa structures and Canada-US treaty benefits to potentially save $150,000 or more annually, while accelerating retirement timelines by 5 years through higher U.S. salaries. And for business owners, Blueprint emphasizes separating corporate and personal immigration, with Canadian corporations continuing to move into lower tax jurisdictions like Texas, Tennessee, or Florida. The critical insight here isn't the tactics, it's the framing. Blueprint isn't describing tax evasion, they're describing rational optimization in response to a system that increasingly fails to retain people it most needs to keep. The dream for their audience isn't home ownership in Canada anymore. It's accumulating enough resource to leave. That brings us to our own segment, because if capital is leaving at the macro level and people are engineering exits at the individual level, we wanted to understand what the squeeze actually looks like for the Canadians caught in between. Since 2022, grocery prices in Canada have risen approximately 22%. Over the same period, other consumer prices rose an average of 13%, and as of December 2025, food inflation had climbed back to 5% year over year, the highest since late 2023, with beef up 17%, and even staples like bananas up more than 8%. Canada now leads the G7 in grocery inflation. Wages grew roughly 4.2% over the past year. The math just doesn't close. Now layer on insurance. Home insurance rates rose 7.6% in 2024 and 5.28% in 2025, both well above headline inflation. According to the insurance industry, the driver is climate-related claims. Canada paid out a record $8.5 billion in insured losses in 2024 alone, 12 times the annual average from 2001 to 2010. Alberta homeowners are paying an average of $660 more per year than they did a decade ago. Ontario is up $519 per year. This isn't a one-time adjustment. Insurers have signaled that 2026 rates will continue rising as, according to them, climate risk is being repriced into the market permanently. Now add the mortgage renewal wave. About 60% of Canada's entire outstanding mortgage book is rolling over across 2025 and 2026, roughly double the normal annual pace, because of the concentration of 5-year fixed mortgages taken out during the pandemic at historically low rates. 5-year fixed holders renewing now are looking at an average payment increase of 15 to 20% compared to their December 2024 payment. At RBC specifically, the average monthly payment increase for renewing borrowers is $513, a 22% jump. Here's the argument that needs to be made clearly for a Canadian investor audience. The mortgage stress test is not the reassurance it appears to be. When these mortgages were originated in 2020 and 2021, the stress test asked one question: can this borrower handle a rate shock? It was not designed for a world where the rate shock arrived simultaneously with 22% cumulative grocery inflation, insurance premiums up 30 to 40% over a decade, and wage growth that has consistently lagged the real cost of staying in Canada. Passing the stress test means you can make the payment. It says nothing about what's left afterward. The data backs this up. Canada's household savings rate has fallen to 4.4% as of the fourth quarter of 2025, down from 5.2% the quarter before. Canadians are not saving their way through this. They're spending down buffers to stay current, and the income gap is widening. Statistics Canada reports the gap in disposable income between the top 40 and bottom 40% of households hit a record 49 percentage points in early 2025. The recovery in household finances that the headline numbers suggest is real, but it is not evenly distributed. The people benefiting are disproportionately the same people McFayden identifies as already halfway out the door. For Canadian investors, this is the demand story that lives underneath the housing debate. It isn't about defaults. The Bank of Canada is clear that it does not expect mortgage renewals to cause a systemic break. The risk is quieter than that. It's disposable income that doesn't flow into renovations, discretionary retail, travel, or move-up purchases. It's a generation of 35 to 44-year-olds, the highest debt service cohort in the country, running tighter household budgets each year with less room to participate in the economy as consumers, investors, or buyers. That's a slow drag, not a crash, and slow drags are harder to trade around than crashes. 3 segments, 1 story told at 3 different angles. At the macro level, McFayden documents a decade of capital leaving Canada faster than it arrived, a structural outflow that rate cuts and FDI summits can only partially address. At the individual level, Blueprint Financial shows that the rational response to that environment for those with the means and mobility is to simply leave. And at the household level, the data shows what the squeeze looks like for everyone else. Grocery bills up 22% since 2022, insurance compounding annually, and a mortgage renewal wave landing on top of it all. The stress test protected the financial system. It failed to protect disposable income. The Canadians who can engineer an exit are doing so. The ones who can't are absorbing the cost of staying. For investors, the question is what that implies for domestic consumer demand, housing market depth, and the long-term productivity trajectory of an economy that is, by the Bank of Canada's own research, losing its highest earners at a rate that accounts for 3/4 of the GDP per capita with the United States. Well, that's your daily brief for today. All credit goes to the creators featured. Their original analysis and videos are linked in the description below. If you found this video helpful, please subscribe, hit the notification bell so you don't miss our next brief, and don't be afraid to comment if there's another creator you think deserves a highlight here. I'm Steve. As always, nothing here is financial advice. Everyone's situation is different, so please do your own research and talk to a qualified financial advisor before making any investment decisions. Good night.